Welcome to our deep dive into escaping the financial fee trap, especially for self-employed professionals. In this video, we'll expose hidden costs, show how to maximize tax-advantaged accounts, and explain strategies like the solo 401k and the backdoor Roth IRA. To keep things flowing, we'll move step by step from the problem to solutions to a practical 30-day plan. Let's get started. Here's today's agenda. First, we'll define the fee trap. Next, we'll prioritize which products to leave behind. Then we'll cover the solo 401k and the backdoor Roth IRA. After that, we'll discuss how to leverage low-cost brokerages and finish with a practical 30-day transition plan, key takeaways, and a couple of quick quizzes. Before we begin, this video is for educational purposes only. It is not financial, investment, tax, or legal advice. Everyone's situation is different, especially for self-employed individuals with variable income and unique tax considerations. Please consult a qualified fiduciary financial advisor, or CPA, to tailor these strategies to your needs. High and recurring fees compound against you, reducing long-term wealth significantly. In this section, we'll outline how to identify these costs and set the stage for replacing them with low-cost alternatives. Let's move from recognizing the problem to a clear action plan. Start by reviewing every account. If you see front-end load funds that take more than 5% upfront, prioritize exiting those products if costs and penalties justify it. Variable life or variable universal life policies are typically poor investment vehicles due to commissions and internal costs. Next, identify ongoing administrative fees of several $100s a year that add no value. Verify expense ratios. As a rule of thumb, low-cost, broad index funds with expense ratios under 0.1% can dramatically reduce drag. If a product has surrender charges now, consider a timed exit to minimize losses. Otherwise, transfer to a low-cost brokerage and invest in diversified index funds. Now that we've identified the traps, let's compare high-cost versus low-cost approaches head-to-head. On the left, high-cost products often include sales loads, elevated expense ratios, and additional administrative fees, which together can significantly erode returns. Recommendations may be commission-driven, and structures can be complex and less liquid. On the right, low-cost approaches focus on zero-load funds, with very low expense ratios and often zero administrative fees, especially at major online brokerages. These options are transparent, liquid, and typically align better with long-term wealth building. Next, we'll visualize these differences with an illustrative table. This table is illustrative and not predictive. Actual costs vary by product, provider, and market performance. Over multi-decade horizons, loads, higher expense ratios, and ongoing administrative fees can amount to very large dollar differences. The point is not to promise specific outcomes, but to highlight how fee structures compound against you. With that context, let's move to the most powerful account for self-employed earners, the solo 401k. The solo 401k is a standout for self-employed individuals because it combines both employee and employer contributions, often allowing much higher total contributions than IRAs. Many major online brokerages offer low or no setup and administration fees. Your targets are to maximize the employee deferral up to IRS limits, then add the employer contribution based on your net self-employment income. Keep investment choices simple. Broad, low-cost index funds. Be mindful that costs should remain minimal and that plan compliance becomes more complex once you hire employees. Also, remember contribution and filing deadlines. Next, we'll walk through setup steps so you can take action. To set up a solo 401k, first select a low-cost brokerage that offers a plan with minimal or no fees. Open the account using the provider's application and obtain the plan documents. Link your business bank account for contributions. Configure both the employee deferral and the employer contribution within the IRS limits. Choose simple, diversified index funds. Automate contributions to match your cash flow. Finally, track contribution deadlines and keep your plan documents organized for tax reporting. Now that we've covered the solo 401k, let's address income limits for Roth IRA and how to navigate them. When your income exceeds Roth IRA limits, consider the backdoor Roth IRA strategy. The basic flow is to make a non-deductible contribution to a traditional IRA and then convert that amount to a Roth IRA. To avoid complicated taxation under the pro rata rule, Ensure you have no pre-tax IRA balances at the time of conversion. Report the conversion using IRS Form 8606. Next, we'll visualize this with a simple sequence diagram. This sequence diagram walks through the backdoor Roth IRA process in order. You, as the investor, contribute a non-deductible amount to a traditional IRA. It's important to ensure you hold no pre-tax IRA balances to avoid the pro rata rule complications. Shortly after the contribution, you convert the amount to your Roth IRA at tax time. The Roth IRA and you effectively report the transaction to the IRS using Form 8606. This visualization reinforces the timing and documentation aspects. Now that we've covered Roth strategy basics, let's test your knowledge with a quick quiz. Quiz time. Which product is most commonly a poor investment vehicle for long-term growth due to high costs and commissions? Options are A. Variable life insurance, B. A low-cost total market index fund, C. Treasury bills, and D. An HSA invested at a low-cost brokerage. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Variable life insurance. While these policies can have a role in specific situations, as an investment vehicle, they often include multiple layers of fees and commissions that impede long-term growth compared to low-cost index funds. Transition your accounts to reputable, low-cost brokerages that support solo 401k and backdoor Roth workflows. Use broad, low-cost index funds to build a simple, diversified portfolio. The guiding principle is to continually minimize costs while maximizing contributions within the rules. To help you implement, let's lay out a 30-day action plan next. Over the next 30 days, first inventory existing accounts, fees, and any loads or surrender charges. Next, open accounts at a low-cost brokerage and begin transferring assets. Then, define a simple target allocation using broad index funds. In week 3, configure both employee and employer solo 401k contributions, if eligible. Execute the backdoor Roth and prepare the documentation for Form 8606. Finally, automate contributions and schedule recurring fee audits and periodic rebalancing. To visualize the year ahead, let's look at a simple savings timeline. This Gantt-style timeline organizes the year into setup, contributions, and review cycles. The setup includes opening accounts and completing rollovers. Contributions include frequent employee deferrals, periodic employer contributions, and monthly backdoor Roth actions where applicable. Reviews include quarterly fee audits to ensure costs remain minimal and semi-annual rebalancing to maintain your target allocation. With the plan in view, let's distill the key points. The key takeaways are: aggressively reduce costs by avoiding loads, unnecessary administrative fees, and high expense ratios. Leverage the solo 401k to maximize contributions. Consider the backdoor Roth to access tax-free growth, taking care to avoid the pro rata issue. Use low-cost brokerages for transparent and scalable account setups, and automate contributions while conducting regular fee audits. Second quiz. Which is a primary advantage of a solo 401k for the self-employed? Options are A. Guaranteed investment returns, B. Ability to combine employee and employer contributions for higher limits, C. Exemption from all IRS reporting, and D. Elimination of market risk. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. The solo 401k allows both employee and employer contributions, which can lead to higher total limits compared to an IRA. It does not guarantee returns, it does not eliminate market risk, and it does not exempt you from IRS reporting requirements. To wrap up, identify and exit high-cost products. Maximize your solo 401k contributions. Use the backdoor Roth if your income exceeds limits. Consolidate at low-cost brokerages. Automate contributions. And maintain a disciplined schedule for fee reviews and rebalancing. Finally, let's end with a quick thank you and a call to action. Thanks for watching. If you found this helpful, please like the video, share it with a self-employed friend, and subscribe for more content. In the comments, tell us which fee you eliminated this month and what your next move is. Solo 401k, backdoor Roth, or both.